In the first video, we talked about how blessed we are in this time, in this culture, that things generally for us are going pretty well. And we talked through just a quick case study of what's really going on with our friend Alex and his family. 3 kids, working a job, he's got a budget, financing vehicles reasonably. He's saving $1,000 a month towards retirement. That plan, unfortunately, gets him to his goal 9 years late, but he's doing things well. He's wondering, what can I do to make things better? So last time we talked about what's really going on. Today, we're going to talk about what's really going to help. And the goal is, how can we add such a foundational tool called the infinite banking concept to what Alex is doing to help him begin to close the gap? And I'm going to walk through a simple case study, continue this of, here's what Alex is doing, here's how infinite banking can help, and then how can Wealth Without Wall Street provide some strategies to help benefit and close the gap. And the goal is, let's create a secure financial future. Let's make sure that the blessings that we have today, we're able to continue in the future. Alex is able to really provide for his family. So what we're going to do is I'm going to just share quickly, what in the world is the infinite banking concept? How can it work just to help with these cars? And what does this create that helps close the gap in future income? And I want to connect this to, how can we do all of this more safely? So let's do that first. What is the infinite banking concept? This is a picture of Nelson Nash. He is the man who founded this concept, came up with this idea. He was blessed in many ways and was creating a great income, very entrepreneurial. Tough time happened in his life in the late 70s, early 80s, when some financial headwinds came his way. Not only was he maybe overspending a little bit, but also interest rates in the environment caught him by surprise, and just some family issues led him to a period of contemplation. He realized that the tool of life insurance, specifically whole life insurance at a mutual insurance company, provided benefits that he could tap into and begin to finance his own things in life rather than going to the banks constantly. Think about our friend Alex and his home and his vehicles. This man, Nelson Nash, discovered that he could put capital, his cash, his resource into whole life insurance policies and take loans against those insurance policies to pay off the banks. And instead of making his payment to the banks, he could make the payment back to his own banking system using life insurance, and do this over and over and over. And he was able to get rid of that endeavor with the banks, that business partnership that he had been entering into, and do that for himself, and then pass that down in his family. In a sense, that's what the concept is about. And we're going to apply this to Alex, again, as a case study to show, here's how this can work, and here's how this closes the gap in the income. And the goal is for you to think through, what are the things that you're doing? What payments are you making? How could you take those over using this concept, using the vehicle of life insurance? And would this create a closer gap to your need of future financial security? And would this help you do it more safely? Here's just a quick quote from Nelson Nash's mainline book. It's called Becoming Your Own Banker. It says, the whole idea is to recapture the interest that one is paying to banks, finance companies, for the major items that we need during lifetime. Cars, appliances, education, homes, those are normal. Investment opportunities, business equipment, and we're going to talk about that next. How do we go next level with this concept and help us fully close the gap? That's where we're going, but we're going to focus first just on the cars. So let's jump back into Alex's situation, see what he can do. So here's a new foundational thought process that Alex can follow. But first, just a couple quick things about Alex, right? He's been buying cars. His wife is going to need a new one soon. When he's done paying off his car, they're going to trade in his wife's car And his plan was to go finance and make another $350 a month payment for her car and keep doing that. He's got an emergency reserve. He's got cash put to the side. In fact, he's got 6 months of a reserve. He's been a good saver. He's been a good investor so far. He's got about 6 months of reserve in his family budget of $6,500 a month of expenses. So he's got about 40 grand in emergency reserve. And so keep those things in mind, $350 a month, and he's got cash in reserve. In addition to that, one more thing that's important. If we look back in the video, the first video, we looked at his budget, his scorecard of finances, and we saw that he was already paying for life insurance. He has term insurance on himself, very normal. And so the first thing that Alex is going to do is he's going to look at that $200 a month, and he's going to redirect the life insurance premium from his term insurance to use as a baseline funding for an infinite banking style life insurance policy. So he's going to take that from his budget and redirect it. Nothing changes in his lifestyle. He just starts to create a new foundational tool with it. The next thing that he's going to do is, instead of holding the emergency reserve in a bank account earning nothing, he's going to move that over a number of years, 8 years specifically. He's going to move that 40 grand into this whole life insurance policy. And for the first car that he purchases, that's going to be the funding mechanism for this next car. Instead of borrowing all the money from a bank, he's going to borrow against his emergency reserve that he's going to hold in a life insurance policy. Once he does that the first time, he'll never have to do it again. He'll build up the cash, and that's going to get him started. So he's roughly going to take half of his emergency reserve to finance his first vehicle. Hopefully that makes sense to you. You may need to listen to that again to capture it. Hopefully that's clear, but that's the plan. So with that, he's going to capitalize his infinite banking whole life insurance policy with the $200 a month from his current life insurance budget, and then transitioning his emergency reserve into it. So he's going to put $200 a month, $2,400 a year to the insurance policy, an additional $5,000 a year for 8 years from his emergency reserve into the insurance policy. So what he'll do then is finish paying off the car, his car, and in 3 years, when that payment is done, he'll take from the insurance policy and the trade-in value of the car, and he'll go purchase his next car. That $350 a month for the car in his budget, instead of paying to the finance company, he'll pay back to the life insurance policy. Once he's done paying that back, he'll be able to go and buy his next car. So the result of this is that doing nothing different, nothing in his budget changes. He just makes one major shift from using the bank to finance his vehicles, to using his own cash reserve and building up his own infinite banking life insurance policy and begin financing vehicles through that. If he just does that and does that until age 65, we can look at the result of that. So here's a question that I would have for you. If you're doing this, financing anything, your home, your cars, student loans, anything like that, if you're doing that from a bank, how much income is that going to create for you in retirement age, at passive income time? When you're done working, how much is that payment that you're making to the bank over and over and over? How much income is that going to make for you in the future? The answer is zero. And so just at a baseline, we can use this tool. We can redirect a payment that we're making to another financial institution and make it to our own bank. And we want to look at what's the end result of that. Here's a summary. I'll give you a quick glance at the numbers just to prove it. And then we want to explore, if we can do that, it gets us closer to our goal, but what can we do next? So if he does that, he turns 65, life insurance policy is going to have grown. He'll have taken loans against it and purchased the cars. When he turns 65, he would turn on the ability to take $10,000 a year in passive income out of the insurance policy. If you want more, if you're asking, well, how in the world does that happen? Loans and passive income, you need to know more about that. Again, join the Wealth Without Wall Street community. We have tons of resources. I can help you implement this strategy once you learn it. But this is how it is. $833 a month in passive income from age 65 until age 90. No problem. When he does that, that's not reported on a tax return, not subject to taxation. The growth inside the life insurance policy, if done correctly through somebody who really understands this concept, that's all done in a tax advantaged way, not subject to income tax. If Alex were to pass away at age 90, he would have contributed a total premium between his redirection of his life insurance budget and putting in his emergency reserve over 8 years. He would have put in $112,000 into this plan. He would have been able to purchase all his vehicles through his own banking system. And just think about the implications of that. Not only does it create a future income for him, but he gets to be in the role of the bank. He gets to be in control of those payments, right? Whereas he was paying the bank before, every single month, payments due. If he doesn't make the payment, the bank comes and gets the car, right? If he plays the role of the bank, he does take over flexibility of those payments. So as we're blessed today, if life turns sideways like it did for Nelson Nash and caused him to come up with this concept, if that happens to us and we're in the role of the bank, we control the payment. We can take a pause. We can adjust the payment schedule. We could even, if life goes the other way, we could pay it off early and benefit from that. We have those abilities. He would be able to purchase all his own vehicles. Taking $10,000 a year out in passive income from age 65 to 90 is $260,000 of income. And if he were to pass away at age 90, based on the projections of the life insurance policy, he would still leave a death benefit of $114,000. So doing nothing different, paying for life insurance, financing vehicles. He would put in 112, he would get a total benefit of about 270. That gets him closer, right? Not only does it create more value for him in the future, but also him needing to replace his income at age 65. It takes that 9-year gap, if you remember, take him till he's 74, doing what he was doing there, taking $1,000 a month, putting that into a retirement plan. That would help him get much closer, right? An additional $800 a month in passive income, just doing this one thing, helps him close the gap on his income needs. So just very quickly, if you're like me, you're like, Ernie, you're sharing these numbers, I have no idea where you got them. Well, I'll just summarize it for you. Alex is age 35. After 1 year, he makes this premium payment, $5,000 out of the emergency reserve, $2,400 a year, $200 a month of the life insurance, gets him his new life insurance premium. That first year creates $5,200 of cash, and right off the bat, about $140,000 of death benefit. So he does this the first 3 years. He's got $17,000 that he can borrow against, and the trade-in value of his car, he can go get that new car for his wife, update it. Take that $350 a month that he was paying to the bank, and he can pay that back to himself. For the next 5 years, be able to repay his own bank, be able to go back to it, take a loan, go get his future cars. By the time he's 46, right, that premium, $2,400 a year, $200 a month, he does that until he's 65. At that point, total access to cash is about $204,000. At that point, he turns off the premium. No more goes in. Until 90, he's able to take out $10,000 a year. And when he passes away, got to make assumptions here about his life, right? I'm not good enough to know exactly what his scenario is. Again, he would have put in 112. He would have taken out 114 in income, not total income, but death benefit. He would take out 260 in income and leave 114 in death benefit. That there's some, right? We got to make assumptions about the performance of the life insurance company. Again, we can learn more specifically about that tool and that process inside our community. But the bottom line, right? Alex is going to be doing these things. He's been disciplined to do them so far. We just do one thing different and start to take over the banking function for these vehicles. He transitions his emergency reserve, makes it work harder. He moves his life insurance budget from one form of life insurance into this. And just doing that, he creates an additional roughly $833 a month in passive income. That's closing the gap. That's what can really help, right? What's really going on is he's behind in his plan in the future. And doing infinite banking helps him take over some control and helps him speed up, close the gap in his income need. Just doing this one thing. So now, if that one thing works, what else could Alex do, right? He's got some bigger goals from just buying cars, right? He's got some bigger things that he wants to accomplish. And so I want to give some perspective in the next video of, if Alex did what many of our members inside of Wealth Without Wall Street are doing, how could we close the gap? Maybe how could we surpass this? And so we'll talk about that in the next video.